Bitcoin was born as a rebellion against the traditional financial system. In 2009, an anonymous creator known as Satoshi Nakamoto introduced a decentralized currency designed to bypass banks, governments, and Wall Street institutions. The idea was revolutionary. Money without intermediaries, transactions without borders, and control firmly in the hands of the people. But over the past decade, something unexpected happened. Wall Street, once the antithesis of Bitcoin's ethos, began infiltrating the cryptocurrency space. Hedge funds, investment banks, and publicly traded companies now dominate a market that was meant to be decentralized. How did the dream of a financial revolution become a playground for institutional giants? Let's break it down. Wall Street enters the crypto arena. Initially, Bitcoin was largely the domain of tech enthusiasts, libertarians, and retail investors. The market was chaotic, unregulated, and volatile. But by 2017, Wall Street institutions saw potential, not just in profits, but in legitimizing a once fringe asset. Firms like Goldman Sachs, JP Morgan Chase, and Fidelity began exploring Bitcoin trading, custody services, and futures contracts. Suddenly, what had been a decentralized experiment became part of the mainstream financial ecosystem. Wall Street's involvement brought credibility, liquidity, and stability. But it also introduced traditional financial incentives, profit, leverage, and control that some argue are at odds with Bitcoin's original vision. The rise of Bitcoin ETFs and futures. One of the first major steps in Wall Street's takeover was the creation of Bitcoin futures and ETFs, exchange-traded funds. In 2017, the Chicago Mercantile Exchange, CME, and the Chicago Board Options Exchange, CBOE, launched Bitcoin futures trading. This allowed hedge funds and institutional investors to bet on Bitcoin's price without holding the actual asset, introducing sophisticated trading strategies, derivatives, and in some cases, manipulation opportunities. Then came Bitcoin ETFs, approved by regulators after years of debate, enabling Wall Street clients to invest in Bitcoin through traditional brokerage accounts. Suddenly, Bitcoin was no longer just a digital asset for tech-savvy investors. It became a product for institutional portfolios, retirement accounts, and massive trading desks. Public companies buy-in. Another turning point was when publicly traded companies began adding Bitcoin to their balance sheets. Companies like MicroStrategy and Tesla purchased billions of dollars worth of Bitcoin, signaling confidence and encouraging other institutions to enter the market. This trend had a twofold effect. It boosted Bitcoin prices dramatically, but it also tied the cryptocurrency to corporate performance and investor sentiment. In other words, the market became more influenced by Wall Street behavior than by decentralized grassroots adoption. Bitcoin. Decentralized in theory. Institutional in practice. Today, Wall Street dominates many aspects of Bitcoin: trading, custody, derivatives, and corporate holdings. What was meant to be money without intermediaries now often requires sophisticated financial instruments and professional management to participate at scale. This doesn't mean Bitcoin has lost all of its decentralized features. Peer-to-peer transactions, blockchain transparency, and open-source protocols still exist. But the story is clear. Wall Street has effectively professionalized and monetized the crypto market, turning a radical experiment into a financial asset class. Why it matters. The takeover of Bitcoin by Wall Street has profound implications. Accessibility versus profit. Retail investors still have access, but the market is increasingly influenced by large institutional moves. Price volatility. Big money trades can drive massive price swings, sometimes disconnected from adoption or utility. Regulatory pressure. Institutions bring scrutiny. Governments are more willing to regulate Bitcoin when major financial firms are involved. A decentralization debate. Purists argue that Wall Street's influence undermines the core principle of Bitcoin, decentralization. Yet, for better or worse, Wall Street's involvement has legitimized Bitcoin. It's no longer fringe tech. It's now considered an alternative asset class, alongside stocks, bonds, and commodities. A double-edged sword. Wall Street's entry into Bitcoin has transformed it from a rebellious idea into a mainstream financial powerhouse. It brought legitimacy, liquidity, and massive growth, but also centralization, volatility, and influence that some say contradicts Bitcoin's original vision. Whether you see this as evolution or compromise depends on your perspective. One thing is clear. Bitcoin today is a hybrid, part decentralized revolution, part institutional asset, and the story of how Wall Street took over is still unfolding. Wall Street's institutional takeover, the next chapter. By 2025-2026, what started out as a fringe digital experiment has evolved into something that Wall Street no longer just tolerates. It actively manages, trades, and integrates into the financial system. Big banks, asset managers, hedge funds, ETF creators, and even corporate treasuries are now major players in Bitcoin's global market. And this shift is reshaping how Bitcoin functions in the financial ecosystem. Bitcoin Spot ETFs, Wall Street's gateway into crypto. One of the most crucial developments in Bitcoin's institutional evolution has been the explosion of spot Bitcoin ETFs. These are investment funds that hold actual Bitcoin on behalf of investors, letting Wall Street clients buy exposure through regulated brokerage accounts without owning the coins directly. Major asset managers like BlackRock and Fidelity launched some of the largest Bitcoin ETFs ever. And by 2026, BlackRock's iShares Bitcoin Trust, IBIT, and similar funds have drawn tens of billions in institutional capital. These ETFs function as a passive accumulation engine for Bitcoin, meaning they buy Bitcoin from the market and hold it rather than just trade derivatives against it. What makes this important is the scale. Institutional flows through these ETFs have become a primary driver of Bitcoin demand, often overwhelming retail activity, and establishing Bitcoin as an institutional asset class. Wall Street banks offering custody and trading services. Another big step occurred when traditional banks, the very institutions that once criticized Bitcoin, began offering crypto services to their clients. For example, US Bank restarted its Bitcoin custody services for institutional investors, enabling asset managers and funds to securely store Bitcoin with a trusted, regulated financial institution. Custody, the secure storage of digital assets, was once a major barrier for big investors. That barrier has now been erased, opening the floodgates for serious capital. Meanwhile, major Wall Street banks like JP Chase are also edging deeper into crypto. Reports suggest JP Morgan is exploring regulated Bitcoin and crypto trading services for institutional clients, including spot and derivatives trading desks. Giants like Morgan Stanley. More than just trading. Some institutions have gone even further. Morgan Stanley has filed with the U.S. Securities and Exchange Commission to launch its own spot Bitcoin trust, making it one of the first major U.S. banks to seek regulatory approval for a Bitcoin fund, a move that signals long-term strategic commitment. This isn't just about trading. It's about embedding Bitcoin into the portfolios of pension funds, endowments, insurance companies, family offices, and sovereign wealth funds. Clients who demand regulatory clarity, liquidity, and institutional infrastructure before allocating capital. Tokenization and Wall Street infrastructure shift. Another development is the broader integration of tokenization by Wall Street infrastructure providers. According to recent industry observations, major exchanges like NASDAQ, New York Stock Exchange, NYSE, and CME Group are actively pushing tokenized financial instruments, meaning traditional assets like bonds, treasuries, and collateral are being handled on blockchain rails. This movement shows that Wall Street isn't just trading Bitcoin. It's rebuilding the plumbing of finance itself on blockchain-like technology, blurring the line between crypto markets and legacy financial markets. Structural shifts, market concentration, and liquidity. Institutionalization has also changed how Bitcoin trades. Instead of the old retail-led liquidity, ETF flows, custody-managed capital, and professional trading desks now influence price discovery. A large portion of Bitcoin and Ethereum's over-the-counter (OTC) trading volume comes from institutional investors rather than small retail accounts, and capital that once would have rotated into smaller altcoins now remains concentrated in Bitcoin and Ethereum. This shift explains why Bitcoin's price dynamic today often reflects macroeconomic conditions and institutional risk appetite, similar to gold or major commodities, rather than just retail enthusiasm. The regulatory backdrop. From hostility to engagement. A major enabler of Wall Street's takeover has been shifting regulatory frameworks. In some jurisdictions, regulators like the U.S. Securities and Exchange Commission have eased aggressive scrutiny, even removing crypto from key 2026 examination priorities, signaling less adversarial oversight and greater confidence in regulated investment products. At the same time, new forthcoming crypto regulations are expected to bring clearer frameworks for custody, trading, fintech operations, and digital asset services, meaning Wall Street institutions can operate without fear of sudden enforcement actions. The belt-tightening reality. Market forces at play. However, institutional involvement isn't risk-free or purely bullish. Recent market dynamics, including net outflows from Bitcoin ETFs and broader macroeconomic uncertainty, show that institutional capital flows can also drive volatility and liquidity churn. A recent report revealed periods where major ETF managers moved significant Bitcoin and Ethereum holdings back onto exchanges, which could potentially signal rebalancing or selling pressure. This complexity is a reminder that institutional participation doesn't eliminate risk. It amplifies structured financial pressures, making Bitcoin behave more like a macro asset within the global financial system. Wall Street's crypto influence. Good or bad, today's Bitcoin market reflects a hybrid system. On one hand, Wall Street's involvement has provided legitimacy, infrastructure, and massive inflows that many believe are necessary for Bitcoin's survival as a global asset class. On the other hand, critics argue that this dominance undermines Bitcoin's original vision of decentralization and financial democracy, a narrative that drew early adopters to the project in the first place. Some long-term market observers argue that Bitcoin's new role is less about freedom from traditional finance and more about integration into it, echoing the sentiment that institutions didn't join crypto. They absorbed it into the existing financial hierarchy. What this means for the future. Wall Street's takeover of Bitcoin is not just about price or market cap, it's about power, control, and legitimacy. Bitcoin today sits at the intersection of decentralized technology and traditional finance infrastructure. Institutional adoption may continue to grow through ETFs, tokenization, custody services, and new regulated products. Yet, this same adoption means Bitcoin's price dynamics, liquidity, and strategic role in portfolios are increasingly shaped by professional investors, macro strategies, and regulatory incentives rather than purely grassroots demand. If you want to understand the future of money, this is where the story gets fascinating and controversial. Hit like, subscribe, and drop a comment below. Do you think Wall Street's takeover of Bitcoin strengthens it as a global asset or betrays the original decentralization dream? Share this video so your friends can join the discussion, because Bitcoin's future isn't just about tech, it's about power, money, and who gets to control the next financial era.